The step 7, we're thinking about options contract. We're thinking about options contract. Okay, what are we supposed to do when we have to use options as a basis of hedging interest rate risk? Same as we did with features, because options are on the features contract. The only difference here is that the features will give you an obligation. Even if you make a loss, you would have to honor it. But the option will give you a right. The option will give you a right. Okay, so let's see. Here too, you would have to start with what date contract. You have to enter into the contract that will mature immediately after the transaction date. Then instead of buy or sell, we don't say buy or sell in options. We talk about a call or put. Okay, a call option gives you the right to buy. A put option will give you the right to sell. A put option will give you the right to sell. Therefore, if we sold future contract, then we need the option on that features. So we need the option that will give us the right to sell the futures contract. And therefore, the option that will give the right to sell is what is called the put option. So we have to buy a put option to have the right to sell the sterling futures contract. We calculated the number of contract. If you remember, under the features, there is no need for you to calculate that again. So number of contract, that's the same as under features contract of 80 contract. There is no need for you to calculate it again because you got it from the features. Okay, you will need to calculate the premium because the option that is giving you the right, you will only have access to that right upon the payment of a premium. So there's a need for you to pay a premium. And how do we calculate a premium? The options, there were 3 exercise prices. There were 3 exercise prices, 93,750, 94,000, and 94,250. Okay, so we decided to pick a match put option. So for each of those exercise prices, there will be the need for us to pick the match put option. Go to the put option column. Go to the match column. What are the premiums for each of the exercise prices in there? And if you go there, you see 0.045%, 0.168%, and then 0.300% for each of those exercise prices. Those percentages are per annum. We are borrowing for a period of 4 months, so expressed into 4 divided by 12. And the amount involved that we are borrowing is 30 million. So for each of those option exercise prices, the total amount of the premiums we would have to pay will be the amount to be borrowed multiplied by the premium multiplied by the period upon which you are borrowing, which in this case is only 4 months. Alternatively, you can calculate the premium as the number of contract entered into, which in this case is 80, multiplied by the contract size, which is given as 12.5, multiplied by the premium, which is 0.045 for the first one, and then multiplied by 100. All of them will give you the same answer. So whichever is easier for you, you can decide to use any of them. Okay, then there will be the need for you to know the futures closing prices. The futures closing prices, which you had also calculated them already so far as you did for the futures. Therefore, there is the need for you to go to your futures and bring the prices in here. So, if you remember, if interest rate is increasing by 100 basis points, then we said the closing future price will be 92.96, and if interest rate is decreasing by 100 basis point, then the future closing price is going to be 94.96. So what then will be the profit or loss on the options? Remember, so far as options are concerned, you have got a right, you haven't got an obligation.